Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very decent day in the markets today and a very beautiful long weekend as well. And in today's action, well, guys, we got a very big red day in the markets today. And of course, that was for a few key reasons. You could argue that maybe we've just potentially had our two first black swans of 2026 as the S&P and the QQQ erase all of their year-to-date gains and are now in the red for the year. The S&P down 1.19% for 2026 and the QQQs down a little bit lower, down almost 2%. Today was the worst day in the markets since a previous tariff day, which was October the 10th, when President Trump administered new tariff potentially on China overall. And now, of course, the headline of the weekend was the tariffs potentially against the entire European Union, or at least 8 countries as part of the European Union because of the whole Greenland situation. But there was something else going on behind the scenes today, which was kind of overshadowed by the Greenland news, but definitely had an impact on the markets overall. You can see the VIX was up tremendously today. Over the course of the past 2 days, the VIX is now up a whopping 26%, but the story was in the yields. Take a look at your 10-year yields right here for the US markets. Of course, take a look at your 20-year yields as well. They rallied an absolute ton, eclipsing a lot of the highs that we saw coming into the end of last year. And the reason was these guys right here, the Japanese, well, I guess I can't get it pulled up real quick. The Japanese 10-year yields overall were substantially higher. Let me just pull it up for you guys. JP should be working. JP10. That's the benefit of doing all these live, right? You guys get to see the mishaps too. Look at the move in Japanese yields over the past 2 days. Yesterday, while the US markets were closed, and today. This is a 6 standard deviation move. Doesn't usually happen that much, putting some pressure on the infamous yen carry trade as Japan continues to struggle to rekindle growth in its economy, rekindle some inflation, and as a result, yields have just been moving substantially higher and higher and higher. We talked about this carry trade the last time in November, where yields were really rocketing here. They spent most of the month of December kind of flat, but with an upside tilt. And then to start off this week, guys, you got a big unwind. So today we had a mix of 2 different things. Big Greenland headline, which did obviously add some volatility. And number 2, the Japanese yen carry trade, that infamous trade that seems to just rear its ugly head at the worst possible times. That was also happening behind the scenes. And in today's video, of course, we're going to talk about it all and relate it as to how it pertains to our overall markets and whether or not this indeed is a nice buy the dip opportunity. Quick hint, it is. But should we be buying slowly and methodically, or is this dip possibly able to just get bought back up in a really quick fashion? So talking about today's video, we'll do a few things together. Number 1, we're going to go over the news headlines for today, talk about Greenland, talk about the Japanese yields, and then of course talk about a few other key elements from the news cycle that I thought would be relevant to today's video. Thereafter, we will cover one big earnings that had their the company that had their earnings after the close today, which was Netflix. So we'll take a look at their earnings, spend about 8-10 minutes on those, derive whether or not Netflix, despite its continued falls, and even after earnings, they fell a little bit more, now down to about $83. Is Netflix still a buy, and when will this stock actually turn around? After that, we'll get into our technical analysis of the markets. As we know, we've lost a few daily uptrends in today's action, right? Big sweeping daily downtrends and cracks of support. So we'll take a look at some of the technical analysis and rotation analysis amongst a lot of these sectors in the market. After that, we will take a look at our big tech names. Big tech got absolutely washed today. So we'll take a look at some of these names. A lot of these big tech names, guys, are down 15, 20+% from their all-time highs. We know the large cap tech trade has not been very popular over the past 3 months. So are these companies still good buys, or should we maybe reposition our money elsewhere? And at the very end of the video, we'll spend a couple moments just, having a quick 1 minute of silence for this entire list right here. The biggest gainers and losers of the day. Obviously, there were many more losers than there were gainers on a massive day of broad market sell-off like today, but we will kind of pick apart some of these names and derive which of these names could be very interesting in the event that they drop a little bit more. And that's going to be it for today's video. So should be a fun one, action-packed one on a very action-packed day. Let's get right into it, shall we? So the S&P down 2.04, the Qs down 2.12, and take a look at the heat map. It was not very pretty. Big tech leading the way down. NVIDIA. What did NVIDIA do? They were down 4.4% today. A lot of big tech names. Look, Apple, Amazon down 3.5%. You very rarely see that. Tesla down over 4%. Google, Meta down about 2.5% apiece. And Microsoft was still down about 1%. Look at Oracle, though, and some of the SaaS names as well. Continues to be a bit of a SaaS apocalypse, SaaS Mageddon. One of our members in the Discord today said a disaster, which I thought was a very good pun. But yeah, still software and even some of your infrastructure names down huge today. The banking sector also down huge as they continue their declines after earnings. Credit cards weren't so bad today, but the major banks definitely did take a little bit of a spill. Healthcare, not too bad. Definitely one of the bright points of the market today. The bottom half of the market, well, your outperformance came from, once again, consumer defensives and a whole bunch of dividend names, which was a key theme heading into 2026 as we've been noticing the broadening out of the market away from large cap tech, which was the former safety trade, into certain aspects of the market that, because of a bullish macro backdrop, are getting some love, right? Consumer defensives being one of those. But overall, guys, not a very good day in the market. Not many sectors in the green, only basic materials and consumer staples. Well, consumer staples says here was flat, but the rest of the market heading down in a very big way. Technology and consumer cyclicals leading the way right there. 1 week relative performance, we have unwound some market breadth, very normal after a 2% down day on the S&P, which saw most of the market heading to the downside, but still a somewhat balanced market. If we take a look at our breadth analysis, well, we were kind of peaking into some highs recently, right? And I have these two areas labeled on the chart for that specific reason. Whenever the short-term market breadth clips into the 70s, that's usually when the market can take a little bit of a breather. Obviously, when you have volatility catalysts, well, that's going to be a good excuse to bring the market down, such as the Greenland piece of news, the Japanese yen bonds, also in terms of piece of news, right? So obviously, tough to determine exactly what's going to drop the markets, but when it does happen, they can curl back fast because we were in slightly rich territory in terms of market breadth. Percentage of stocks above their 20-day EMAs, still healthy, 56%, but off the highs of 70 recorded a few trading days ago. Percentage of stocks above their 50-day EMA also kind of came into the danger zone right here. You'll see, guys, this is can go back like 20 years on this chart, right? And every time we kind of pull up here, if there is a reason to sell the markets off, they tend to drop in a rapid fashion as most of the market was participating to the upside and now just gets kind of flushed. So this one down to about 62% off the highs of 71, and percentage of stocks above their 200-day EMA, same concept, right? We were approaching a critical area here, which we touched a few times in 2024 and 2025. 66% of stocks just the other day were above their 200, and now that has kind of collapsed down here to about 62. All very healthy reads still objectively, but definitely synonymous with a broad market pullback such as today. So before we get into more technical analysis, guys, let us go over a few key pieces of news that happened today. And of course, the big one, if you watched my top 5 options video yesterday, you probably would have seen it. Or if you just watched the news cycle, you probably would have seen this as well. Trump saying that 8 European unions face tariffs rising to 25% if Greenland isn't sold to the US. The tariffs would start as a 10% rate on February the 1st and shoot up to 25% on June the 1st, which many people liken this to Liberation Day 2.0. It's probably a far cry from that. If you remember the infamous tariff board that was pulled out on April the 2nd, you might remember tariff rates that were like 30, 40, 50, 60, 100% on different countries. This is nowhere close to being a Liberation Day event, but it is a volatility event for the markets, of course. Now, of course, we also know Trump's negotiation tactic after seeing many of these former tariff levies in the past. Usually what happens is the president goes in with a very heavy ask in terms of what he wants, and then they kind of negotiate down to the middle ground that is supposedly what the president has always wanted all along, right? Such is the deal-making nature of the Trump administration right now, but this definitely will rock the markets in the short term. Now, we had a bit of an update yesterday evening, very late, in which President Trump also released on Truth Social that he had a very good call with the Secretary General of NATO regarding Greenland and has agreed to a meeting with various parties in Switzerland. Now, this was already on the table. President Trump was already going to be in Davos, Switzerland tomorrow morning. So I guess they'll be talking about the topic of Greenland as well. So we will have to wait for further updates on this situation. But of course, it is a volatility catalyst for the markets. And until it is resolved, it just gives a bearish element, a bearish narrative the market can use to go into a consolidation phase. So keep that in mind. But something else was happening behind the scenes today, aside from this Greenland news, which kind of overshadowed everything. That was released Saturday morning, so kind of tough to see it coming when we last did our video update last Thursday and Friday, right? That being said, listen to what Scott Bessent had to say today about the Japanese bonds unwinding and how he believes that today's market reaction has nothing to do with Greenland. I'll give you a little bit of an audio clip.
I believe the markets are going down because the Japanese bond market had a 6 standard deviation move for the past 2 days. that would be in their 10-year bonds. I've been in touch with my economic counterparts in Japan and urged them to take the necessary measures to stabilize their bond market, but that's spilling all over into all bond markets. German yields are up, French yields are up, U.S. yields are up, again, it's mostly the Japanese bond market, got nothing to do with Greenland.
There you go. There you have it. There is Scott Besson saying it has nothing to do with Greenland, but he is not wrong in the aspect of saying that all bond market yields were higher today, from the US to European markets, even Asian markets as well. If you take a look at the magnitude of the Japanese bond rally today, or rather the yield rally today, because the bonds definitely went down, 27 basis points, a 7 standard deviation move, and the most in any day on record. The yield is now approaching a 4% yield on the longer form Japanese bonds. Take a look. This is your move from today, right? And every time this happens, a very rapid spike, well, it tends to have a bit of a destructive element on the markets, of course, because we know that the Japanese government has borrowed a tremendous amount of money to stimulate their economy over the course of the past 20 years. It hasn't really worked, but the problem is that they were holding a very big bag of assets in the process. And whenever yields spike like this, if they have to unwind these assets, well, of course, that tends to be to the detriment of the rest of the world, as they do hold a number of different equities and a number of different bond obligations as well. Moving on a little bit further here, you can see this move expressed even better with a 30, 20, 10, and 40-year bond. You can see that all of these bond yields really in the past few days, guys, have been having their excess standard deviation move, so it does put extra pressure, extra volatility on the markets overall. We will see if the Japanese government has to come in and do a little bit of yield curve control, but as of right now, this is kind of a runaway trade, and it does not bode well for the rest of not only the rest of the bond market globally, but also the rest of the equity market. Everything becomes under pressure as Japan is a very heavy holder of both foreign equities and also foreign bonds alike, so keep that in mind. Moving on a little bit further here, you have more statistics in terms of how broad the market is. So 63% of S&P 500 stocks are outperforming the index year to date, the highest since 2001. And this goes in line with the breadth that we've been describing over the past few weeks. Now, obviously, today when you have a broad market sell-off and everything comes down, well, the market breadth gets a little bit weaker, but it's very notable to us that 63%, guys, of all stocks were outperforming the S&P into the early phase of the year. We haven't seen that in the past 2 years. Look down here, 2022, 23, 24, it was a very concentrated market. And the safe haven trade, or the easiest trade of the bunch, was just long big tech, because you know the rest of the market wasn't really participating. And we've spent the better part of the last 2-3 weeks talking about this broadening out into the everything else category, the infamous 493, with the Mag 7 getting left behind in the S&P 500. So this is very curious to us. We've noticed this without this chart statistic, but it's very nice and very healthy to see the market broaden out like that. Arguably, you get the best market performance when you do have a broad market like this. The last thing that you want to see is constant concentration into only a few key names. So you kind of can't have it both ways, right? The past 2 years, people have been complaining that the market was very concentrated into only big tech, and that big tech was the only reason why the markets were higher. And now you have some people complaining that big tech isn't doing anything and that the market is broadening out, which is not healthy either. So which one is it? Is an unhealthy market, is a concentrated market an unhealthy market, or is a broad market an unhealthy market? If I had to choose one of the two, I would obviously choose the broader market rather than the concentrated market. But I understand if you've been a large cap tech investor in the last 3-4 months, it has not been easy watching other sectors rally while your stocks kind of decline and come to the downside. Very normal there. But overall, just, you know, find solace in the fact that this is very healthy for overall market performance and continuity of that performance overall too. And moving on a little bit further, more about this rotation, Charlie Bolello, who always does some really nice charts overall. Here are your 2026 year-to-date gains. As you can see, small caps are better than large caps, international stocks better than US stocks, value stocks better than growth stocks, and Mag 7 in the red. And as he said, the reversal of everything. We've been talking about this for the past 1 to 2 months. Almost every single week we bring this up, the broadening out into everything else. Take a look down here, whether international markets, emerging markets, and even US small cap markets, everything is outperforming either US large cap growth stocks or specifically the Magnificent Seven. And we described a few times as to why. this trade, the Mag 7 trade, used to be the safety trade because you had somewhat sketchy macro backdrops. I'll take you back to this same moment in time last year, January of 2025, when the recession odds were still slated to be 25-30%. GDP growth rate was somewhat awkward. The inflation rate was still higher than it is right now. And additionally, guys, you had some, you didn't have the rate cutting cycle that we have today, nor did you have the end of quantitative tightening, nor rather did you have the big boost in earnings that we've been seeing over the past 2 quarters. So the macro backdrop has improved, which is why the market is taking upon itself to broaden out, right? If there was still a lot of uncertainty, people would probably still be hiding in big tech because big tech was a very easy trade to hide behind, right? Very nice margins, very big free cash flows, very large moats behind these companies as well. So all this rotation is healthy, but as I said previously, guys, obviously it's very unfortunate when you are stuck in some of these Mag 7 names and they're not doing anything when you're seeing the rest of the market rally to all-time highs or close. So that's everything for your early news cycle. Now, once again, before we get into more charts, let's cover some earnings. And we're only going to do Netflix today. Now, there's not too much on the table in terms of earnings. I mean, there's many companies, but in relation to the ones that retail traders pay the most attention to, there really isn't that much. So today we'll just focus on Netflix. Shout out on Thursday. We do have Intel coming out there as well. The bigger weeks of earnings are arguably in the next 2 weeks when you get the rest of big tech and when you get a lot of very fun fan favorite retail names such as, names like Robinhood or SOFI or things of that nature. So we'll do a lot more in terms of earnings recaps over the next 2 weeks. This week, I may just keep it a bit light and focus on the price action, especially if we get a few more red days. I think the price action and the charts are going to be where we're going to spend the most amount of time rather than talking about, some of the more value-oriented names that could make their way in terms of the earnings cycle this week. So talking about Netflix, what happened with Netflix today? Well, they did report their earnings, and unfortunately, they went down, and they went down pretty heavy in extended hours here, guys. I mean, not only were they down, roughly 1% during the regular session, they went down another 4%, bringing the total day loss to about 5% to the downside. So what exactly happened? Did they have bad earnings? Well, no, not really, but the infamous Paramount deal, or rather Warner Brothers Discovery, when they're battling with Paramount for the deal, it's causing a massive overhang on the stock, and that has been the case ever since the deal was announced very early December when Netflix embarked on its next leg of selling after getting brutally beaten down from its all-time highs. Well, the next leg of selling came down here in terms of that deal. So let's take a look at some Netflix numbers, and you will see they're actually pretty solid. So if you take a look at the headline numbers right here, revenue, that was a nice beat as well. 12.05 versus 12 billion. That is 18% year-over-year gains. Very strong. EPS also came in with a beat. Operating income wasn't too bad at 30%, and operating margins also 24.5% too. Free cash flow, 1.87, which did beat the mark of 1.46 billion. So why was the company down? Well, it had to do with the guidance, but also, they suspended their buybacks because they're shoring up cash flow for the infamous Warner Brothers deal. Take a look at your Q1 2026 guide. EPS a little bit light here, 0.76 versus 0.81. That'll do it for a bit of a decline. Revenue also coming in marginally, $40 million under the estimate. So obviously, when you have a big red day like today and Wall Street is being very picky, well, this is enough to bring the stock down. Operating margins as well, 32.1% in Q1 versus the expectation of 34.4%. Now, they missed the mark, but I'll show you why these numbers are not objectively bad. They're actually much better than last year at this same time. And for the full fiscal year 2026 outlook, well, they beat on revenue outlook, but coming in slightly soft in terms of operating margins. The company justified this by saying they're going to be incurring some decent content costs in the first half of 2026, but it should give them a very good program offering for the back half of the year. So they did have to reduce their operating margins guidance, and free cash flow coming in about $930 million under the estimate, which also is something else that Wall Street pays heavy attention to, especially when you're going into like a $55 billion, cash and debt deal for Warner Brothers Discovery. Ad revenue, though, expecting to double versus 2025. After doubling ad revenue, actually 1.5 times, so like a double, not quite a double and a half, but 2.25 in terms of a X factor on the advertising revenue from 2024 to 2025, they're expected to double the advertising revenue again into 2026, which is obviously very, very solid. Moving on to a bit further numbers from Netflix here, topping 325 million subscribers. They do not provide subscriber numbers that often anymore. Probably at this point, maybe twice a year, once at the halfway mark and once at the end of the year. Good subscriber growth, grew 8% last year, definitely not a slowdown or a lack of subscribers for Netflix. Their advertising tier has been one of the biggest drivers for subscriber growth right there. Moving on to a few more things here, you can see a beautiful chart of Netflix with a few different key things. Total revenues is your, the bar chart, the big red bars right there. Very beautiful revenue expansion. Total revenue percentage change is also very healthy, still growing double digits in terms of mid-teens. And here you have on the orange, free cash flow, which is a closely watched metric by Wall Street. Free cash flow up and to the right. And next year we have their guidance as well around that 11 billion. So it'll be another year in which Netflix really improves its free cash flows overall. Moving on a little bit further here were some of your best performing shows and programs by Netflix overall this year. You can see the staggering amount of viewers that turned in to these shows overall. So still a very highly competitive streaming service. One of the best, obviously, the de facto winner in terms of the streaming wars, unless you compare it to YouTube, but definitely over and above Apple, Amazon, and other platforms like that, such as Disney, in terms of total viewership and total subscriber counts overall. Moving on to the shareholder letter, you will see that a few key salient facts here are the free cash flow numbers. So 1.87 billion was the recent free cash flow. Now, Q4 for Netflix every year is a little bit soft because that's when they do their big capital outlays for the content that they're going to produce into the first half of the following year. You can see that even in Q4 of 2024, we dropped on free cash flow, and then Q1, right, tends to be a much better quarter, which is the expectation as well for Netflix moving forward. And as a result, you can see the operating margins in Q4 also fall. Same thing with last year, but you can see the operating margins are better than they were at this same time last year. And Q1 of 2025 was 31.7. This upcoming Q1 will be 32.1% in terms of operating margin. So a little bit of seasonality for the company right here, but it's because they put so much spend into content into the Q1 and they use the money for Q4 to kind of do that, right? But year-over-year comparables, Q4 to this Q4, very good. And Q1 comparables versus last year's Q1 in terms of the guidance, also very decent. So yes, they did miss the analyst expectations, but year-over-year comparables are still quite good. So just keep that in mind if you're a Netflix shareholder. It was not a bad report at all. Moving on a little bit further here, you will see that, where do I have it highlighted? Now, this is another piece of news that brought the company down. We first prioritize reinvestment in the business, both organically and through selective M&A, mergers and acquisitions, talking about the Warner Brothers deal, while maintaining liquidity and then returning excess cash to shareholders through share repurchases. Consistent with that framework, we will pause our share buybacks to accumulate cash to help fund the pending acquisition of Warner Brothers. And Wall Street didn't like that, and I don't assume retail investors appreciated that as well, because they did have about $10.1 billion in buybacks in the pipeline, which is pretty good. It's about 2% of your overall share float. This money will be reallocated to the Warner Brothers Discovery deal. Now, the deal, in my opinion, I've said this many times on the channel, will be accretive to the business, but there will be some short-term integration pains and there will be some short-term narrative and noise pains as well. The deal might only go through at this stage in March, right? Maybe not before that. In terms of some conference call summaries right here, we set internal goals to double revenue and triple profits. And when we set those goals, M&A was not included. Since then, we've seen modestly better growth, so we think we are making good progress, and the opportunity ahead of us is massive, which it is, in all fairness. We are seeing increasing competition, which is changing with innovation. That is nothing new for us, though, and we are energized as ever to entertain the world. We don't expect our content in 2026 to be as back-end loaded as last year, but that means higher year-over-year content expense growth in the first half of 2026, which is also why they're missing a few of their operating estimates into Q1 as well. But we've already talked about that, but just to reiterate, right? We saw member growth, improved our member churn year over year, and customer satisfaction is at an all-time high. This reflects our focus on delivering value, which directly translates into revenue growth. We really weren't looking for M&A, but when we began our due diligence on Warner Brothers, we got really excited. They have a television business that complements ours really well, and they have a well-run theatrical business too. They also have a premium online streaming service, And this all leads to a very good and very achievable opportunity for us. So talking about good synergies between the businesses, of course, right? We really see it as an accelerator for our growth strategy with the added benefit of a complementary scaled TV and film studio with 100 years of deep content and IP. So as I said, guys, it probably will be an accretive deal to the business over the long term, but we know when these companies go through these big acquisition periods, there's going to be a lot of noise and there's going to be maybe some shareholders that just throw in the towel at this point in time, but not me. I still do believe that Netflix is a very solid company, a very nice company in terms of profit margins, free cash flow growth, and very nice subscriber retention and subscriber growth over time. They are, in my opinion, the best streaming service, pure play streaming service, because you can make an argument that YouTube is kind of in a category of its own. But when we compare Netflix against other offerings such as Amazon or Apple or perhaps Disney or even HBO, the numbers definitely do favor Netflix in terms of profitability, subscriber growth, low churn, and just overall being the more favored household name for many people. Now, that being said, that doesn't really help us right now because the stock just continues to collapse. As we said, it's down here at 83. So what can we possibly find solace in? Well, number one has to be the valuation, right? After this earnings, where do we stand? Well, at $83, we currently stand at about a 25.614 PE. Not that expensive for Netflix at all. That is a 1.28 PEG, very decent PEG ratio, and a 2.36% free cash flow yield. So the valuation of Netflix is definitely a lot cheaper than it has been in the past. And we know that management's guidance is to turn this into a $1 trillion company by the year 2030, which is a very good compound annual growth rate moving forward. The company is only worth about $400 billion right now. So this company doesn't really have a revenue growth problem. It doesn't have a capital efficiency problem in terms of margins and things of that nature. It doesn't have a free cash flow problem. All it has right now is a bit of a sentiment and noise problem. And arguably, those are some of the best buys that we can buy in the market because you know that the long-term business is not being disrupted right now. There's just going through a little bit of noise. So I do really enjoy Netflix down here at the lower 80s. I will continue to buy more shares, but just keep in mind, it will take a bit of time to turn around this sentiment. We're going to have to get through this noise in terms of the overall deal, but it was a very decent quarter. As a Netflix shareholder, I'm pretty happy with this quarter. Of course, certain elements could have been better, but that can be said about many other companies in the market. Very decent quarter for them and does not change the long-term fundamental aspect of the business, in my humble opinion. So that's everything we had for Netflix earnings. Hopefully you guys enjoyed that. Now let's get into some charts. So first off, as we always do, the good old S&P 500. So unfortunately, the S&P 500 guys losing the daily uptrend and also losing the 50-day EMA, two key themes, right, that you have to pay attention to in terms of short-term price action. Now, the futures market is green right now. However, we do have that meeting with Trump in Switzerland tomorrow, so possibly a bit more volatility action on our hands. That being said, line in the sand was broken, and we did crack our short-term support level and the 50-day EMA. The next stop for the market's 674, down about 666. There is a little bit of a gap to be filled down here. If you take a look at the hourly charts without the extended hours on, my bad. So there is a bit of a gap fill here right down there, December 18th, which could bring you down an extra % or so, right down to the 670s, deeper into support. Short-term hourly is oversold on the RSI, so you might get a bit of a bounce here, but you'd be bouncing into what is now going to be resistance, and the bears do have another chance to go for that gap fill overall. 4-hour conditions, not quite oversold, and daily conditions, not oversold either. So what you're seeing right now is a bit of a breakdown in terms of the time frames. We obviously talked about this many times. We had a bit of a rising wedge here on the SPY, and you had a equal wedge here on the, or a bull flag right here on the QQQs. That unfortunately did break down. So you do have certain technical patterns playing out with the added volatility. Completely normal that the directional bias right now, short term at least, is to the downside. You cracked a few levels, brought in the volatility, surprised everybody. Now it's up to the bulls to play a bit of defense here. We're also losing our 12 EMA on the weekly. We will see how we close the week. Line in the sand for the QQQs on the weekly is 672. You lose that, you lose the weekly uptrend, and then it just might look something very awkward like last December into January as well, where you did see a little bit of chop here. So I do believe it might just be a choppy landscape early January. Your next big target, though, would be the weekly 26 EMA, and as a result, you might just head into a little bit more monthly consolidation to start off the year. However, the macro backdrop is not bad. We've talked about this many times, so it is indeed a buy the dip opportunity, but we have to be buying it slowly and methodically, right? I'm focusing a lot of my efforts recently onto big tech because a lot of these companies are down 15, 20+% from their all-time highs. and there's been no changes in their business model whatsoever, but I am also playing a bit of a barbell approach. You might remember me buying a little bit of value this year and also buying a little bit of small cap growth. So, you know, a lot of my efforts, most of my efforts are still focused on large caps, especially large cap tech, not only the Mag 7, but large cap tech. But I am also putting about 15% of my portfolio into some value and dividend names because I do believe it's kind of a cyclical rally for them that could last more than just a few weeks. And also 15% into small cap growth, which is expressed by, you know, certain names in the Russell and also certain international names as well. So keep that in mind. Moving on to the QQQs right now. We talked about it, right? Breakdown of the pattern. They tried to break to the upside out of this bull flag, sadly got rejected, and now the daily downtrend is amongst us. So we are into support right now. 605 is the end of that, but there is additionally a gap to be filled from that December 18th, same as the S&P, right? That being said, that could drop us another 1% all the way down here to roughly 600 if they do want to go for the full gap fill. Your next area of support is just a little bit under that, call it about 596 down to about 589, and there you would have a big weekly sell-off that would take out our weekly lows at 600. So you would lose this attempt for a weekly uptrend. And as I said, just go into a bit of a very choppy period in time, kind of like we saw last December and last January, which would, in other words, also mean a bit more monthly consolidation. Now, we've been doing sideways monthly consolidation for the past 2 months, arguably on the Qs, right? A little bit more downside would just look all too healthy for the markets after 6, 7, 8 months of printing gains to the upside. It all stopped early November, and it hasn't really pushed ever since because big tech has been muted, right? So if you do pull back a little bit more, pay attention to the 12 EMA. This, in my opinion, is maximum pain, both for the S&P and the Qs in the short term. That would entail a bit further declines. I'm not saying it's going down there. I'm just telling you where's max pain. 5% more on the S&P, and for the Qs, that would also be another roughly 5-6% to the downside. So we'll see if they complete the pattern. The S&P and the Qs have been no stranger to attacking the 12 EMA whenever we have a bit of volatility and whenever we have a news cycle that does permit it. And the news cycle that we have right now with the Japanese yields and obviously the newly established tariff tantrum because of the Europe situation, those are really not things that you can just snap your fingers and just kind of move away from, right? They're things that we're going to have to constantly monitor over the next few weeks. Essentially what I'm saying is, does the market have the narrative and does it have the juice to go for the full retracement, which we've been talking about for the past few weeks? It does, right? With the failed breakout, the breakdowns of the levels overall, it has momentum. Whether it does it or not, that's anybody's guess, but you should be prepared at least for the max pain scenario, which means you should be periodically spacing out your buys and deriving a very nice watch list. But I do believe that this is going to be a nice buying the dip opportunity. When we take a look at this in forward settings, right? 2, 3, 4 months away, you probably will be happy that you've bought these dips because the macro backdrop for this year is pretty good, which is something we've been talking about for the last few weeks on the channel, right? Moving on to XLF financials, more consolidation in financials right now, daily downtrend. And we know that's been happening from the banks after their earnings, right? We kind of had a cascade of selling after JP Morgan earnings, Bank of America earnings, and then just never really recovered. But all of this is healthy market price action, right? Same thing for financials, as we just described. 7, 8, 9 months of upside, you got to set the monthly higher lows eventually, right? JP Morgan is doing it right now too. You got to set the monthly higher lows, and what better area to target than the monthly 12 EMA? And you can see that even better on XLF as a chart overall. Short-term timeframes are lost. We're cracking below the area of support, 54.30 down to about 53.30. That being said, if they drop it a little bit more, weekly, looking for a weekly higher low, anything above 51, looking for that higher low, possibly coming down to here. I need to rebuild a little bit of price action structure. And the monthly, still in the context of a monthly uptrend, but maybe they want to go for the 12 EMA tag again. So keep that in mind for financials. Now, moving on to healthcare right now. Healthcare up, down about 0.22%. Not the worst day for healthcare overall, guys, but still, right? Losing a little bit of steam right here. Daily downtrend into a little bit of weekly consolidation. The bigger area to pay attention to is definitely this 152 to 150 area. If you lose that, we're going to go once again into monthly consolidation. I'm bringing up all these longer time frames, guys, because it's always important to remember where you are in the grand scheme of things. Healthcare is a very potent sector for 2026. But is not immune to that monthly consolidation phase as well. If you do come down there, 148 to 144, probably where I would be looking to build a little bit more swing trades on healthcare if I wanted to kind of participate. Moving on to semiconductors right now. Semiconductors falling off a cliff, but it was kind of concentrated into a few key names right here. You'll notice that a lot of the equipment manufacturers down a ton, right? AMAT, KLAC, et cetera, et cetera. And you also had some declines right here in some names like ASML and things of that nature. Even Micron had a very good start to the day. They still ended green, but you can tell, right? A little bit of softness on some of the memory names. Not SanDisk, though. They continue to outperform, but there are a few names that can get some rotation, right? Thinking about maybe NVIDIA, thinking about AMD can get some further rotation, although they've done nicely recently, right? And even Marvell, right? All these names are decently off their all-time highs still. So we know we saw a big boom into the equipment manufacturers, ASML, LRCX, things of that nature, and names like Micron and names like SanDisk. So if the rotation does happen within the context of the semiconductor trade overall, I would be looking to the larger names such as NVIDIA, AMD, Marvell, some of those chip producers and things of that nature, especially after TSM earnings that we covered on the channel last week. So keep that in mind when looking for semis. But daily uptrend still in the bull's control right now. Pay attention though. You lose this, sadly you unwind, and you might be going for a bit more extended consolidation on the higher time frames, right? Weekly could definitely use a pullback, maybe to here into the 12 and form resistance. Next target 371. On to the Russell right now. So the Russell has been outperforming recently, but today unfortunately came down with the rest of the market, but not as bad as the rest of the market, right? Really a bifurcated market right now where value and small caps are outperforming large caps, and specifically large cap tech, right? That only happens when the market is wanting to broaden out, right? Big tech used to be a big safety trade for 2023, 2024, and 2025, which is why the market was so concentrated. But now you wouldn't really see big money rotate into cyclical aspects of the market, such as anything consumer oriented, whether staples or discretionary, but especially not in growth stocks. The big money usually only does that rotation if they deem that there is a nice macro backdrop that will allow sustained movements in those sectors. So keep that in mind, right? Daily uptrend still very healthy, looking for a higher low, anything above 246 higher low, possibly for some further trend continuation. The weekly also, a lot of room here, guys, right? Beautiful weekly uptrend, and the monthly as well. Beautiful monthly breakout, but if the rest of the market continues dropping, this one will not be immune, but growth is probably a very nice aspect of the market to be in 2026, 2027, as you get some of that small and mid cap growth right there. As a matter of fact, a lot of the best performers of the year so far in the S&P have been some of your more mid-cap names, right? And the Russell has just been consistently outperforming. Moving on to our minor sectors right now, talking about XLP, consumer staples. Very nice chart right now here, right? Beautiful expansion early January. And now if you do consolidate a little bit, if you get a bit tired since we're overbought conditions, looking for a higher low. Nice backtest range, 80.5 down to 70.5. If we're looking for a re-entry, this would be it. We're coming into big resistance right now. If you get a re-entry trade, this could be very interesting to build if you guys want some value, some dividend-oriented trades, just the broadening out aspect of the trade, right? I've kind of described where I'm going to be for this year overall. I have like 15% that's going into value and dividends, which is something that I haven't done because of the macro expansion thesis, right? So 15% of my portfolio is in there. 70% of my portfolio is still in large cap tech and largely focused on large cap tech. I'm not saying I'm only in Mag 7, but focusing on large cap tech and the AI trade overall. And then 15% of my portfolio is in small or mid cap growth. Okay. So that's like kind of my barbell for this year overall, as I seek to also benefit from certain aspects of the market that could have very cyclical breadth, right? So keep that in mind. XLP, not looking too bad. Consumer retail, same concept, right? Although today was a down day pretty much across the board. Retail, not looking too bad. Nice daily uptrend, or nice weekly uptrend. Daily, pulling back a little bit, but the higher lows are here. 85 on the daily and the weekly as well. So watch the pullback location. The monthly is clearly gone, right? You can clearly see what's going on here. Nice monthly leg of expansion. Utilities, still a very interesting sector for this year, but I'll be focusing on the utilities most closely associated with the data center trade. Names like Vistra, names like Duke Energy, right? Names like Energy Transfer, right? I know that this one is an oil and gas pipeline trade, but pay attention to the names that are closely tied into the data center trade. Shout out to Next Era Energy as well. So some of these utilities providers, right? And some of your Oil and gas plays could be very interesting into this year, especially if you're focusing on data center-centric names overall, as now utilities is trying to find or trying to embark into its weekly bottoming out process, but also monthly bottoming out process too. Very hot trade, in my opinion, for 2026, especially those independent power producers. Real estate could also be a fun trade this year with the declines in the Fed's interest rates and the end of quantitative tightening, right? So it could bode well for a lot of real estate names. This XLRE is pretty much a lot of REITs in this one as well. There's certain aspects of the market that could be interesting. Rocket Mortgage on a pullback down to 20s or under 20. I'd be interested to play there. LDI, Loan Depot, another smaller mortgage name in terms of just overall market cap, right? That one could be interested. So the mortgage brokers, but also the home builders, guys, pay attention, right? These are a few aspects of real estate that I'm playing. So possibly some REITs. The REITs that I'm interested in myself personally are names like Vici, and maybe even a name like Public Storage that hasn't really done much over the course of the past few years, right? Very high quality name, REITs, in my opinion. So pay attention to that. Home builders, some REITs, and also the mortgage trades too. And lastly, XLE. So this might be a year, and there's more and more talk of this on the street, how this could be a year where even if the barrel of oil stays roughly flat or down, you actually might have some outperformance by a lot of the oil companies because they haven't done anything in like 4 years, right? And the market's just broadening out into key different themes right now. One of those themes is XLE. So this XLE ETF is just a combination of a lot of oil companies that has the largest weight in them, but you don't only need to play oil. I'm still a big fan of playing this XLE breakout, but you can also play certain themes like nuclear, right? Either this ETF, NUKZ, or NLR if you don't want to pick out the names yourself. I do think that nuclear is going to be very popular. The administration has just deemed uranium to be a critical mineral for the purpose of the national security, right? So that being said, even spot, right? If we're looking at spot uranium, SRUF, not too bad, guys. There's a very, very, very large uranium supply deficiency over the next few years. So we're talking about a theme and a narrative here that isn't only limited to the next few weeks, the next few quarters. No, it's multi-year. And you guys know that I do enjoy these multi-year themes overall. So pay attention to that. Moving on to the VIX right now. The VIX, we talked about it in the introduction, but just to kind of reiterate where we're going here. Obviously, this is like a slap in the face rally where the VIX from the Friday session is up 27%. Now, the last time this happened with the tariff situation was China, October the 10th, and you can see that it did cascade a little bit more. So the VIX may not be done. We can see a little bit further to the upside here, but I do believe we're closer to the end of the volatility than maybe towards the beginning. But it can be a bit of a sticky narrative. Tomorrow, Trump's comments while in Switzerland will obviously be key to this volatility trade overall, but it's great if you're an option seller, right? When the VIX comes into here, you really want to explore selling options when you're above 20 because you get the best risk to reward for some of those premiums that you do collect. So keep that in mind. Moving on a little bit further to the metals trade right now. So gold had a very strong day Tuesday, 2%, and now in the overnight markets, we're up another 1.5%. Now, we know gold has many faces, guys, and we've talked about this trade many times in the past. There's the whole central bank aspect to gold, how they're accumulating more, the aspect of that a lot of world governments are moving away from holding dollars as reserve, but not only US dollars, all dollars, US dollars, euros, yens, pounds, right? And this has been a theme over the course of the past 2 years as the gray shaded area here, global gold reserves, goes to the upswing. So this is a central bank trade here. There's also a bit of an uncertainty hedge too at this point in time, right? So gold has many faces of right now, all of which are quite bullish for gold's price action. So that being said, gold, very nice daily uptrend, looking for a higher low on any consolidation, anything above 45.39, looking for a higher low. It looks like it wants to make its move towards the ever so elusive $5,000 range. The weekly is very strong as well. Clear weekly uptrend, overbought conditions on the weekly though, and overbought conditions on the monthly. So just keep that in mind. Gold is in a very awkward position for me. You guys know that you can only really do 3 things with any trade, right? It's either a buy, a sell, or a hold. Gold for me right now would just be a hold. It's very tough to go in full size right here. And I don't believe you have to be in a camp of 2 extremes, right? You don't have to really be in the Peter Schiff camp that says that we're about to embark into a 10-year global recession where everything gets absolutely destroyed, right? I think that's a little bit too extremist. But on the flip side, you also can't say that gold is that this move is unwarranted, right? Like there are some key themes here behind gold overall. So we got to keep that in mind. A little bit of exposure is fine, but starting full size position in terms of like selling all your equities and coming all into gold, a little bit of a mistake in my opinion at this current stage, right? But holding a bit of gold exposure as part of a barbell strategy is not a bad idea. And we've been saying this since last year, since we were in the 3000s, right? Moving on to silver right now. Silver had a very decent day on Tuesday, up about 0.23%. So not as much as gold overall, but silver also is a trade of many faces. We know that, well, you guys know, right? The physical prices of silver are diverging from the paper prices of silver in many end world markets, such as Shanghai, etc. Silver arguably has more utility than gold in the production process of things, because we know that silver has its place in many electronics components and many other various industrial applications. So it's a more utility driven metal overall, but it has been taking over. It's kind of like a meme trade at this point in time, right? So silver, I don't believe the risk reward is there anymore. So silver as well for me remains a bit of a trim or a hold, but would not be a full portfolio send up here. A little bit of silver exposure is fine, but thinking that you're early as part of the silver trade is probably not the best way to come into this trade psychologically, right? Because you may just end up disappointed. As I've always said, right, keep an eye if you're trading this one, keep an eye on your daily levels, your daily structure, 86.45, daily high or low, trailing stops. Right? If you're heavily into silver recently, trailing stops will be your best friend, because any asset eventually will have to come into weekly consolidation and monthly consolidation at the same thing. You guys know it best. Nothing ever moves up in a very straight line. So keep that in mind. Have your trailing stops in order if you are trading this one too. So there you go, right? For your metals trades. Moving on to some of the crypto names right now. Well, unfortunately, crypto trades have now unwound, right? So daily uptrend now lost. So unfortunately, these stop losses have been hit for any swing trades. We're now back into the gulag of price action. This big old support range, 94,000 down to 85. Breakout attempt was nice, but a little bit too late, right? Too little, too late. Unable to close the weekly above 94,000. So now once again, you're back into consolidation mode. They had it going for them. Momentum was switching. They had nice price action. Unable to convert though. So keep that in mind. And the same thing for Ethereum too, right? You had some nice momentum. You had the daily uptrend. Unfortunately, with a day like today and a day like yesterday with the volatility, you unwound everything, lost the daily uptrend. Now they got to start everything from scratch again. And the weekly as well, right? You had the weekly breakout attempt. Sadly, no higher highs, so now just consolidation. So in my opinion, no more short form swing trades in terms of crypto. You need to reset your time frames. You need to get a daily uptrend going to get a valid stop loss area in, right? This is just long form accumulation. If you believe in the crypto thesis, you would be long form accumulating on ETH and on Bitcoin, but no short-term trades as of just yet. These short-term timeframes just are not conducive to that type of stuff, at least not in my opinion. That being said, that's everything for your overall market rundown. Now, let's dive into big tech. So starting it off as always with Apple. So Apple unfortunately down 3.5%. Daily downtrend on Apple just continues at this point, barely holding the 200-day EMA and barely holding our level of support as well, 246 up to 256. Now, a lot of these big tech names, guys, not all, but a lot of them are down 15, 20% from their highs. Apple is down 15% from its all-time high. The weekly time frame also unwinding, big daily oversold conditions as we just stated, right? 17 on the daily RSI. The last time that that's happened, guys, was all the way back here during the big tariff sell-off. So Apple is probably coming closer to a local bottom than not. I had one key piece of news here. Let me just pull it up on the bookmarks. Where is it on my bookmarks? Sorry, I got a lot of bookmarks here. So, there's a key piece of data from Apple that I wanted to bring to your guys' attention. That's not going to do it. Give me a second here. Let's pull it up. Real-time stuff here. Oh, there you go. iPhone shipments in China jumping 28% year over year in the holiday quarter. Apple's share rose 21.8% versus 16.8% a year ago. Here are your statistics from Apple overall. Let me just move myself to the side. Good, very good performance growth quarter over quarter. In terms of Q4 last year versus Q4 this year, so year over year, but quarter over quarter comparables, right? And decent market share gains here from Apple. So they should be having a good Q4 earnings print here in about a week's worth of time, but it doesn't prevent short-term slides, as we know that large cap tech has been very unfavorable, at least since the start of the year, right? Since the 2nd of January, guys, Apple is down like 10%. For no news other than rotation overall, right? So keep that in mind. Apple quickly into my buying the dip area right now. And this is going to be the key pocket, right? 245 down to the 26 EMA, 230. This is a nice key area. Apple finally in my buy zone, been waiting for it for a while, so I will be adding a little bit of Apple down here as you kind of move through the time frames. But the bears definitely control everything in the short term right now, so just pay attention to that coming into earnings. I think earnings will be solid, but this is just very healthy monthly consolidation. We were talking about it up here, right? Saying I wouldn't touch Apple up here, but if it comes down into my key structure area, I'll be interested. Well, now I'm interested. Moving on to AMD. AMD actually holding up better than most. They had a bit of news today where Meta said that instead of manufacturing its own, or rather pursuing its own ASIC chips, essentially, right? They are going to be moving more and more towards AMD's offering. So AMD was able to hold up the gains today, but, you know, if we got a few more red days, I wouldn't be surprised if they drag down AMD as well. That being said, short-term price action is kind of all over the place, right? You're looking for the reestablishment here of the daily uptrend. You're looking for the bulls to convert on this beautiful, beautiful engulfing move and keep pushing the weekly uptrend higher. Keep in mind, though, AMD does have earnings the 3rd of February, so I'm not too sure if they'll get the big breakout, especially not with this market right now. If you do pull back a little bit, back to the lower 200s, that's the buy zone. We've been saying it for a very long time, right? AMD looking pretty good right now, under 230, down to 200. You're trading very cheap. You're trading at a 1 peg, right? And an 8.2 price to sales. Fundamental thesis for AMD is as alive as it's always been. If we take a look here at the long-term fundamental outlook here, EPS, massive EPS ramp in the next few years, and a massive revenue ramp. So margins, revenue, all going to be moving clearly to the upside. AMD, still one of my favorite trades, and the monthly has just always been in a phase of monthly consolidation. So if they drop us throughout January, guys, it's once again going to be a nice buying opportunity. So pay attention to it if you're interested for AMD. Moving on to Amazon right now. Amazon not able to hold it up. No negative news today whatsoever on Amazon, just being brought down with the rest of the pack. It seems as though every time Amazon tries to break out, right, something happens in the overall markets. This was the tech sell-off late October into early November after beautiful earnings. And now, sadly, well, you get the big unwind from the Trump volatility catalyst and the Japanese yen, Japanese yields, obviously, too. So Amazon, once again, getting dragged down into the key structure area. We're in a support right now, 240 down to about 230. If you lose that, you're coming right back into the very big chop area, guys. 230 down to about 205, which is my sweet spot for buying Amazon, right? So if Amazon comes down there, I'll accumulate a little bit more. Earnings are going to be fantastic this year. I truly believe that. At 235, it's not a bad buy, under a 34 price to earnings ratio. And the fundamental thesis for Amazon, guys, is still very much alive. Probably one of my favorite names. Just more monthly consolidation. I know it's been slow. I know it's been tedious, but there will come a point in time. Amazon, I believe this year will be Amazon's year in the sun, so to speak, like Google was the year last year for them. I do believe we're looking for a pretty big breakout on Amazon this year. So keep that in mind. Moving on to Google right now. Google also not able to keep it up, down about 2.5%. So line in the sand on the daily, 311. Lose 311, you lose your daily uptrend, just like they did back there. And you might just be heading into a bit of weekly consolidation. Line in the sand on the weekly is the weekly higher low under 300. A lot of room here for Google bulls to consolidate, but you can clearly see, right? Look at the weekly MACD, man. This is like months, 6-7 months of expansion here. If you start losing this, you roll over the RSI that's already overbought, roll over the monthly as well. Well, who knows? Maybe it's Google's time to consolidate. Because so far, now everything else has been doing it, right? The ones that have been holding up the best are arguably Amazon and Google in terms of they're not that far off their highs. But Apple's been coming down, right? Meta's been coming down tremendously. Microsoft's been coming down tremendously. Netflix been coming down tremendously. NVIDIA has not been very favorable either. So maybe, just maybe, if Google takes a bit of a breather now, maybe the money rotates into some of the other Mag 7 names. I guess we'll have to keep that in mind. But Google, for me right now, is just a hold, right? Or a trim profits and reallocate into other big tech names. But Google, very strong company. They should have a good year in terms of earnings. It's just trading somewhat at the top end of their valuation range. On to Meta right now. So Meta down 2.6%, revisiting the big support range. Again, the range that we visited early November as well. 605 down to about 556 is the support range. We did lose short-term structure, daily downtrend, sadly, just continuing at this point. Not yet daily oversold, but very close. And on the weekly as well, just further downside slide. On the monthly, seems as though we want to revisit this 26 EMA again. Watch it though. If you crack it, they're looking for a monthly downtrend there, which is not very good. You might just be going for the full quarterly. I rarely ever bring up this chart, but quarterly retracement will put you mid 500s. I don't know if they do it. I just say that that's max pain if they do it. Earnings coming up the 20th of January. You're getting some pretty good levels on Meta right now, though, guys. If you wanted to rotate into this one, it might not recover instantaneously, but you're in a good position, right? Same thing we talked about during the tariff sell-off and etc. When these big tech companies come down 15, 20% from their highs, and the fundamental thesis hasn't changed, which it hasn't for Meta, right? They can be good buying opportunities. It doesn't mean that it may not be slow or painful in the short term, but long term, these buying opportunities can definitely be rewarded. It's just not very favorable for short-term swings, right? So under 630, low 20s multiple, and a decent forward price to sales as well. So Meta, pretty cheap down here. Here through 560 is an area that I'll just keep adding incrementally to my long-term share position, but no short-term swing trade action for me. Moving on to Microsoft right now. Microsoft as well, down 1.16%. Like, what did Microsoft do since their earnings to warrant a top-to-bottom sell-off of almost 20%? Well, the answer is nothing, just rotation down and healthy monthly consolidation. We've been talking about this for the last 2 months at this point in time. Nothing has changed. We're now into the big area of price action structure. Finally, previous resistance, current support, decent valuation down here under 470 or under a 30 forward price to earnings, a 1.66 peg, which at this stage is probably a little bit lower into the 1.5 peg range. So now finally, even though daily oversold conditions in a support, weekly downtrend, even though short-term price action is unfavorable, this is where we want to be buying if you're a Microsoft fan, right? Into the monthly 26 EMA. When does it ever hit here? Rarely ever. This time during the tariff sell-off of April 2022 bear market, barely COVID, and barely 2018 tariff sell-off there as well. So this is a nice area on Microsoft. It's down 20% from the highs with super strong fundamentals. So this is the area that we do want to add, but it's obviously not very conducive for short-term trades. No, for that, you need a daily uptrend recapture. You need to let them show you where the bottom is. But just to be progressively either playing short puts under the market or accumulating some long-term shares or leaps, not a bad opportunity. Netflix, we already talked about, but just to go over the price action again, weekly oversold conditions. That doesn't happen too often. Matter of fact, the last time that happened was late stage 2022 during that sell-off, and then not really before, unless you count 2011, right? So big weekly oversold conditions, daily big oversold conditions. It's now going to be opening up tomorrow at 83.82. This is the last level, guys. Below 82, unfortunately for me to say, the only other area really is down here at the mid 70s, 200 weekly EMA, right? But we don't really have much in terms of support down there. It's just an EMA average. We're already down top to where we are after earnings, right? We're down almost 40% on Netflix with good fundamentals. So this one, very unfavorable in terms of short-term price action. I would not be going for a quick swing trade long. There's no price action that supports that, right? You got to wait for the bulls to show you where's the bottom. Give me a new daily uptrend, and then we could talk about the bulls' capacity to reverse the weekly timeframes and put an end to this big old monthly downtrend leg of sell-off right now. But this is definitely an area still that I want to be building some shares on Netflix that I will be carrying over the next few years. Moving on to NVIDIA right now. So NVIDIA down 4.38% today. Not the best day for NVIDIA, but once again, theme of the day, no news. They just got dragged down with the Japanese yields, or the yields globally that were rallying, obviously, and the Greenland piece of news as well. But it does present that as a nice buying opportunity. Daily downtrend, loss of support as well, 178. They got one more day to save this before it is kind of lost and before we maybe retest the lower 170s, 170 down to 163. You guys know I enjoy playing short puts down here, but I also would I would not mind buying some NVIDIA shares down there as well. Failed weekly breakout, right? So might just revisit down here. And where is that area on the monthlies, guys? Monthly 12 EMA, right? As well on NVIDIA. So the monthly timeframes, the reason I bring them up so much is once again for context, but also understanding where you are in the context of sell-offs and where you might go, right? NVIDIA has done this trade many times to where it rallies super hard, everybody gets super bullish, and then when it comes down to the 12, nobody wants to buy it because they think the floor is going to come out from under you, right? It's very normal. It's just psychology of the markets, right? But you always got to remember, what are your fundamentals? Around 175, low 20s forward multiple. It's a one peg. You know, NVIDIA is twice as cheap as Walmart right now on a forward price to earnings basis. So keep that in mind, yeah? So NVIDIA, I'm a big fan of buying. It doesn't mean the volatility will stop here. It just means the more you push lower, the better price we can actually get. But unfortunately, large cap tech, we don't have much daily uptrends anywhere. I mean, unless Google and Amazon are your two remaining uptrends, Everything else, and maybe AMD, shout out to them, they're trying for it, right? Everything else is just cascade daily and weekly downtrends. Apple, daily, weekly downtrend, right? Google is the only one holding up. Meta, daily, weekly downtrend. Microsoft, daily, weekly downtrend. Netflix, daily, weekly downtrend. NVIDIA, they tried to go for it. They tried to go for the daily uptrend sweep, never got it. Once again, back to the daily downtrend. Once again, back to the weekly consolidation phase. So keep that in mind. Moving on to Tesla right now. Tesla also not able to keep it up. This one too. Daily downtrend in the mix right now for Tesla. The lower area of support is 405 down to 383. The 200-day moving average is down there as well. The weekly, they're cutting very deep in this move right now, guys. Very deep, right? Not taking anything away from Tesla's long-term positives, but the short-term price action is definitely not the most favorable right now. The monthly, you might just go for the full monthly retracement, right? Monthly upswing, monthly higher lows. Same thing with the rest of our big tech name. Tesla is not in a world of its own. It can't get away from normal price action. If we want to consolidate, you're coming back down there, 405 to 383. That may be a re-entry opportunity for all of your longer-term Tesla bulls that wanted to rebuild some swing longs into 2026, focusing on the long-term positives, FSD, Optimus Robotics, their energy business, et cetera, et cetera, et cetera. Tesla has earnings coming up next week, January 28th on the Wednesday session. Few more, and then we're done. Palantir cracking the support lows and almost losing your line in the sand level here, guys, from the 2nd of January, right? They barely held on to it, but this is a clear loss of support structure, right? We were playing in this area a lot. You can see this whole 185 down about 170 area. You're losing it, right? So sadly, it looks like the bears want to make an attempt for a bit of a new daily downtrend there. They tried to tighten it up, go for the breakout. Unfortunately, flushed with today's price action. So keep that in mind. The weekly as well, right? Weekly, you tried to go for the tightening up move here. Sadly, breaking down. Next stop for Palantir, if you do embark on a further market consolidation phase that brings down Palantir as well, well, the next area of interest for us will be 150 to 140. I know people don't want to hear that, but that would be a very natural market consolidation move into the 12 EMA as well, as we know that Palantir was overbought for a while. See, this is like gold and silver, right? You get monthly overbought conditions into the 90s on the monthly, and then eventually something happens to where the trade just gets unwound, and then you consolidate into monthly 12 EMAs. So possibly Palantir, the next area that I might be interested for some swing trade longs or just exploring the trade idea, right, would be down here, monthly 12 EMA. So keep that in mind. Moving on to SOFI right now. SOFI down 2.45%. This one too, right? We had some nice short-term structure built up there, 26. Sadly, you lost it. So daily, right? Daily downtrend again. The weekly still caught between this range of resistance, 30 down to 28, and below support, 25 to 22. This is the area. We're coming into it now, right? Previous 2021 highs, 25 to 22, same concept, monthly consolidation. I know monthly consolidation sometimes is annoying, but it's a part of the overall market process. This is usually when most of the money is made. After months of consolidation, when people get bored with the trade or frustrated with the trade and they give up, if you guys know what to look for, right? Especially if you're in a monthly uptrend. I mean, look at this beautiful breakout retest of these guys right there, right? It lasted for a while, picked up these lows. Look at the resulting move. I'm not saying that we're going to go for a 3-4x in 5 months from here, but this is going to be the area of interest if you're looking to build further SOFI positions, 25 to 22. Selling puts down here or accumulating some shares down here, not the worst proposition, as we know, under a 27 forward valuation, right? It's a 1.1 peg, looking pretty good, and a mid-7s price to sales multiple. On to Uber right now. Uber also coming down, not as hard as some other stocks, but still down nevertheless, right? Daily uptrend price action right now. They're trying to hold on, but it's just like an ever so slow grind, eroding a lot of this breakout potential right there. Still got a chance to challenge this resistance area. We'll see if they do it. If they just unwind everything and come back down, well, that's your higher time frame bears telling you they're just too strong right now. You may just have to make another attempt into support down here. 81 at about 75 is the range. Monthly, it's been monthly consolidation. As I keep saying, right? Monthly consolidation, I know it's boring, I know it's painful, but it's just part of the normal market process, right? So keep that in mind. It's the same thing, right? Monthly breakout, retest, and it lasted here for a long time. I'm not saying it's going to last this long, but Uber down here, 80 to 76, definitely a decent pickup if it's your style of company. 80 forward multiple basis rate, forward 23 forward price earnings, which is great, and a forward 5.24% free cash flow yield. Lastly, TSM. TSM had phenomenal earnings last week, but seems as though TSM is kind of like Amazon. Whenever TSM reports great earnings, just something happens with the rest of the market, it just brings them down. So maybe the pre-earnings rally was the best part of TSM, as now they're unwinding short-term price action. 4.5% to the downside. Definitely nothing the company did specifically wrong, right? Just the overall market. So keep a watch at your levels right now. TSM, if we lose a little bit more ground here, you're probably coming back down for the back test. Prior resistance, current support, 310 at about 300 is your level of interest. And the monthly would just be looking for a bit of monthly consolidation. This one is just gone. You know, they never really bothered to test the 12 EMA again. I'm not saying they're going to do it right now, but if you come back down to this whole area of price action on the weekly, that would not be too crazy. We did their valuation after earnings at 340. We said, yeah, it wasn't that expensive, right? But it's maybe not a full sin. So maybe nibble on TSM if you're looking to build a position here on TSM for the next few years. Not too bad. I already have all my TSM shares. I'm not really looking to add any more. So TSM for me is like a nibble or a hold up here, maybe not like a full portfolio send buy. And that wraps up all of your market and all the big tech names. I know we ran through them a little bit quickly, but nothing has really changed on the weekly and monthly timeframes for a lot of those names, right? Still just more consolidation, more rotation out of this into the bottom half of the market. You can't see it today, but you guys clearly understand what's been going on for the past month. I don't even know if you can see it on the past 1 month performance here, because there's been a few outliers, but the bottom half of the market getting a lot more love than the concentrated big tech trade, at least over the past 2 months. You guys have cleanly seen that rotation expressed by this chart right here, right? Large cap growth stocks, just not there. Mag 7, just not there. Everything else, though, deeply there, whether that's emerging markets trades or international trades or even US-based small cap trades and value trades. They're all outperforming, right? And the RSP here has been your equal weight SPY, right? Has been the outperformer. That's the best indication of your market breadth. This looks a lot better as a chart than necessarily the S&P does, right? So that's being held back by big tech, so hopefully you understand. Now let's move into the biggest gainers and losers, and spend like 10 minutes talking about some of these companies. So number one, talking about AVAV. This was a big algorithm trade today. Look at that, man. Just clean sweep to the downside here. So unfortunately, unwinding a lot of those gains, but I mean, can you blame them? From the start of the year, right? This one was up how much to the top? 64%. So watch for your reentries, right? Reentries would be down here, in my opinion, under 300. Not too bad, right? Under 300. It is very expensive right now. Don't watch this one. I'll redo the valuation for you guys. Just take my word for it. We analyze this one in the Discord a lot. Reentry trades are down here. Okay, so pay attention to it. If they unwind some of these defense corporations, whether it's this one, whether it's KTOS, that one's up like 65% year to date so far in like 2 weeks. If you unwind this and go for the retracement size, maybe that's the entry that you guys are looking for, even on something like an Ondas, which was up, 8% today, right? Watch the reentry locations down here, closer to 10. You're just unwinding some big weekly moves, going to some consolidation. So if you guys are a fan of the defense trade, right, you don't even have to play it with this one, right? You can even play it with, I believe it's, keep forgetting the ticker. I believe it's ITA. If you wanted to even play this one with an ETF, ITA, just watch for the structural reset down here upon weekly consolidation. It's rallied a ton. Weekly consolidation is part of the game. If you're looking for reentries, right, you should be looking for them into the next few, trading days or a few trading weeks, whichever names you guys are interested in. So pay attention to that defense trade, right? I'll take a look at a few other names. NBIS, because I know a lot of you guys want me to talk about this stuff. NBIS is just a further add for me down in the 80s, as it always was when we talked about it the last few months, still in monthly consolidation, right? So they're trying to go for the upswings. It held up, in the grand scheme of things today, it wasn't too bad. I know 9% is a big number, but, in other periods of time, you guys remember, right? It's very violent price action. It's actually holding up not too poorly right there. If you do see revisits of the 80s, I'll be a fan of adding to my position. Same thing for IRN. If IRN gets rejected here and goes for a bit of a downswing, IRN low 40s. I'm a big fan of this one too. The monthly still looks good, right? They've had a nice early part of the year. It doesn't look like much, yeah, but into Friday, from the start of the year, it was up 53%. So we did a good job of building some positions down here. If they offer a re-entry trade, lower 40s because of the volatility, I might be interested. And if you guys want to play CIFR, same concept, right? CIFR down for me, CIFR down there for me is kind of like a 14 out of 12 trade, if I'm being honest. And even APLD as well, right? APLD gone right now. But if for some which reason we revisit 20s, that probably is going to be the area that you guys should be interested in. It's a bit extended right now. So just play these big retracements into key areas of support and curling up of the longer term monthly moving averages. That's the best thing you can kind of do in these instances, right? Rocket Lab is very expensive right now. Space Trade is hugely popular, whether it's Rocket Lab or, Planet Labs, etc., right? They've had a very great start to the year. Look at Planet Labs up here, bit of a smaller cap name, right? That one was up at the close of, at the high of Friday, 58%. Huge rallies here on the Space Trade, whether it's this one, ASTS as well. They're very, very, very extended. You'd have to give me a tremendous discount. You might remember the last time that I was playing Rocket Lab and interested was down here 44. We're very, very high right now, up in the sky, right? So if you do give a lot of this back, 72 might be the new area where the bulls might want to form a new base on any pullbacks there. For ASTS, that would be something like a, 80s area overall, but of a breakout and then a big, big, big retest in the event that these moves are overdone leading into the start of the year. A lot of those names are deeply overvalued in terms of fundamentals, but I'm pretty sure you guys know that by now. This is a very nice momentum carry trade, but when that momentum moves away, you can get some big consolidations, right? Shopify is one that I do really enjoy. We don't talk about it that much, but it is one of my favorite growth stocks in the entire market. That being said, for me, Shopify is a revisit buy for like long-term portfolios down here, like 130, 120. Give me the 12 EMA test again, which is done many times in recent bull markets, right? Not talking about the 2022 disaster, but in the context of bull markets, usually testing these areas are quite good re-entry points. So keep that in mind. Shopify would be a bit of a nibble for me, 130 to 120. Forward valuation, even up here at 160, guys, it's always expensive. Shopify is just expensive because of the very fast-paced growth rates. So this one could be a nice opportunity for me a little bit down there. I think that's everything. SaaSmageddon, disaster, SaaSpocalypse continues. Figma down ridiculously, right? CRM down ridiculously again today. Adobe down huge again today. And I mean, there's really no easy way of structuring these trades, right? You basically either are calling out the bluff that AI is going to take over their business, whether directly or by seat. A lot of these enterprise resource companies, they count on seats, meaning the amount of licenses that they sell to corporations depends on the amount of employees that corporation has. But if these corporations are going for leaner workforces because of AI efficiency gains, will they need as many licenses as before? That is the main question, right? It's a very big question mark. A very big question mark. It's a very big battle of narratives right now. A lot of these SaaS companies are at their cheapest valuations that they've been in the last 5-10 years, but things can always get cheaper. So please keep that in mind. It's very, very tough to buy these because for the most part, they are falling knives. They've lost monthly structure like CRM, monthly downtrend, Adobe, monthly downtrend. Figma has just been nothing but down since the IPO, right? So if you're buying these, you're basically just buying these with the hope that eventually AI is not going to kill their business. But the only way that you can turn around that is by consecutive good earnings, right? Kind of like Google had to do last year when ChatGPT was supposed to kill their business. Only through earnings after earnings after earnings were the companies able to turn this around. And I do believe that's likely going to be the case for a lot of those SaaS companies moving forward. I'm not participating in the trade. I understand why you may want to participate, but if you do so, you got to do so slowly and methodically. Same thing for names like Duolingo, right? Anything that has the AI narrative against them, you're basically just buying, and you know that the turnaround time is probably not measured in days or weeks. It's probably measured in quarters at this current stage, but we seem to be approaching, what seems to be maybe the bottom of short-term sentiment, maybe not share price, but sentiment, in my opinion, cannot get worse in software. And it's even bringing down some of the retail fan favorite names, such as Zeta has been coming down a lot. Zeta is a good play. I'll be re-exploring adding some shares potentially here all the way through about 17, which is kind of like the liftoff zone. Very clean area in terms of fundamentals as well, trading at like 3 forward price to sales. And other names of that nature like UiPath. UiPath, I'm a big fan of building. This is also part of my mid-cap portion of the portfolio that I was telling you guys about, right? That whole other aspect of the barbell down here through like 13, 12, I think on UiPath is a very interesting entry. It's multi-year areas of support, as you can clearly see, right? Nothing wrong with the company. They literally just posted their first GAAP quarterly earnings of profitability. So there's a lot of interesting names, and cybersecurity has just been getting decimated, right? Names like Fortinet consistently down, names like CrowdStrike consistently down, Palo Alto Networks consistently down, out of favor. Sentinel One, Rubrik, look at Datadog, massive sell-off there on Datadog, just cleanly down every week for the past 3 months. Zscaler down every single week for the past 2-3 months at this point. So there's a big reset in a lot of software names out there, whether direct SaaS or even cybersecurity, which arguably is a very hot market into the next 2, 3, 4 years, a very nice theme. There's been some big sell-offs. So if I'm looking to play any software, I probably will play cybersecurity and maybe not enterprise software such as ServiceNow or Team or Adobe, which has a lot of their revenues coming from the professional cohort. So I'll be focusing on cybersecurity because I think it has the most favorable narrative. Although it's been getting lumped up with the rest of the unfavorable AI sell-off trade, I actually think it has the best AI tailwinds out of any of these businesses overall. So keep that in mind. Other names such as SP Global, right? S&P Global down huge today. You guys know Visa, MasterCard. I'm a big fan of accumulating positions down here. SPGI, if they give us the reentry trades again, SPGI down here, under 500, 490, 480, big fan. Moody's Corporation, some of these more value-oriented names, right? Moody's Corporation, backtest here, under 500. Big fan of adding to those positions as well. Even a name like Brookfield, solid company. You give me a 12 EMA backtest, I'll be adding to this position as well, into the low 40s overall. So there's a lot of interesting plays that are being opened up by the market volatility right now. So pay attention. There's, as I keep saying, right, there's something for everybody. Broadcom as well. Broadcom, not a very good day today, down 5.5% daily, looking like they want to go for the downtrend and maybe looking like they want to crack this support area if the volatility continues. You might just be getting the weekly downtrend on Broadcom, which in other words is just monthly consolidation. This chart is clean. Super clean, as long as you understand what's going on here on the higher time frames. Broadcom, adding a bit of Broadcom down here, lower 300s. Big fan of that one as well. So there's something for everybody, right? Large cap tech. There's some energy company sell-offs with some nice tailwinds, such as Vistra, such as Next Era Energy, right? Is a solid play there. There's some nice plays in energy. There's some nice plays in large cap tech. There's some nice plays in cybersecurity, right? All for long-term potential buys. There's some nice plays in value. So we covered a lot of the themes and narratives today. I'm not going to go through every single one of these companies and tell you guys, here's where I want to buy. But as long as I can keep covering the themes like FLNC, you guys know, battery storage, I'm a big fan. This one, FLNC, if we come back down to about 20, I'm a big fan of buying this one, right? Just battery storage, TE Energy, solar, right? Vertically integrated solar. They actually were green today, but if you do get a pullback here, somehow 6 to 5, if they unwind some of these small cap bullish moves, great wall of resistance, I'll be looking to reaccumulate some of these on their downswings, So as I keep saying, there's something definitely for everybody in this market overall. So keep that in mind. Connectivity plays for data centers. Credo is a name that comes front and center to mind, right? Lower 130s to 120s, decent area. ANET as well in the low 1-teens, like 115 down to 110, decent area. They're all just looking for monthly consolidation, monthly higher lows into the 12 in support. Credo is like the same concept. So I'm just so you guys understand, right? A-Lab, same concept, although they were higher, come back down there, could be really interesting. So pay attention to your monthly levels, guys. When you know that you might be heading into a bit larger form consolidation in the markets because we have some volatility catalysts and the SPY, the Qs are dropping like this, we might challenge the weeklies and might go into a bit of a monthly rollover for healthy retracements. Well, you should be looking at the higher time frames to get a sense of where you may want to position in some of your favorite names in the event that I haven't covered them in today's video overall. I'll try my best to cover more of these names as we kind of move through the rest of the week overall. I don't think there's that much to cover to the upside here. I think we've kind of covered them. Critical minerals is obviously a very popular trade because of the Greenland situation and just because critical minerals is a key theme over the course of this year so far. As I said, if you don't know which ones individually to play, you can always play nuclear ETFs such as NLR. You can also obviously play some critical minerals ETFs like SETM or other things of that nature, right? Rather than individually playing USAR or quadruple U's, or some people enjoy this company right here, United States Antimony Corporation. So these are fun, smaller cap names. They're not for everybody, but there's a key theme here for critical minerals, obviously, over the next, 6, 12, 18 months for that trade overall. Other than that, there's nothing else truly notable that was on the highs today that we can really talk about. I think we've done a good job of just covering the bases in terms of the key themes that we can be exploring and some, whether it's value or small caps or some of the themes like defense corporations or critical minerals or energy, especially energy, right? Some of the metals like copper, some lithium plays as well. So something for everybody in these markets, but I'll try to do my best to cover all these key themes as we move through the rest of the weekend, as we move through the rest of the year, guys. So that's it for me. Hopefully you guys enjoyed today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new as well. We do these videos every Monday through Friday after the close to give you guys the best recaps possible. And last but not least, if you have any questions, concerns, comments, feedback, whatever you guys want, feel free to leave it down below in the comment section. I always love reading your guys' comments, and it really helps me grow the channel as well, because it's kind of tough to find my videos when they're like an hour. But I know you guys like the long form content. That's kind of my niche right now, giving you guys a lot more in-depth explanations, a lot more context. So hopefully you guys do enjoy these videos when I make them. That's all I had for you guys today, right? So pay attention to your longer, higher time frame levels, and just understand that what's going on here, right? It's the good old tariff playbook, right? The tariff playbook is nothing new, short-term volatility, but in my opinion, guys, right, this is a much easier bluff to call than April. Like if this was 10 on 10 difficulty, because it was not very easy, right? If there was no tariff pause, okay, then like if there was no pause a week after Liberation Day, you would have gone probably a lot further and stayed down there for a while, right? As the market's kind of priced everything in. This is an easier bluff to call. Like if this is a 10 on 10 difficulty, this is probably like a 3 or a 4. You can kind of see right through it. They'll probably come to some form of agreement. No, Europe is not going to dump our US equities and US bonds by the trillions of dollars. That would just destroy all of their pension funds that are too closely intertwined to the US markets anyways, right? So you'll see some headline catalysts right there, but it is a fairly easy bluff to call. But it doesn't mean that it's just going to be one day and done, right? You may go into longer form weekly consolidation. It may get a little bit worse before it gets better, but is it a buy the dip opportunity is the moral of the story. I think it is. The macro bullish tailwinds are very strong, and just with the institutional positioning that you can see into cyclicals, right? Cyclicals doesn't only mean semiconductors or things like that, right? No. Cyclical trades and themes, which move with interest rates and inflation. The bottom half of the market and small caps. You do not see the big money rotate into cyclical themes like that have been unpopular for the past 2, 3, 4 years because of high interest rates, because of a somewhat weak consumer, and because of high inflation. You don't see the big money repivot into those themes unless you have a very favorable macro backdrop for the year at hand. So keep that in mind, right? The big money is telling you where to be. The key themes are telling you where is popular early January. But it's not a bad idea, right? Nothing's fundamentally changed with large cap tech. It's just that they are now the underperformers, whereas they were the outperformers for the last 2 years now because the market is broadening out, right? So keep that in mind. That's all I had for you guys today. Have a good day in the markets tomorrow, and I will see you tomorrow after the close. Peace.